Well, as it's 6 o'clock, I think we will crack on. I'd just like to thank you all for dialing in to this evening's session. We've got a wonderful panel for you all. And just a very brief intro from me. I am Sophie from Gain. I'm sure all of you know all about us, but we're a charity here to try and inspire young women to consider roles in the investment management industry. I'm sure all of you will also be aware we are running an internship program. So if you haven't already, please do head to our website and sign up. This is for internships in summer 2022, so next year. And we hope to see you all soon. Anyway, I'm going to hand over to our panel and our moderator, Erin, and hope it's a great session. Thank you very much.
Thanks, Sophie, and thank you everybody for joining. I guess just to start, we'd all like to introduce ourselves. So I am Erin Ennis, and I will be moderating today's panel. I work at Man GLG. I originally started working for Man Group in the US in New York and moved over to London about 3 years ago. And I am an analyst on our UK equities team. So I support 3 portfolio managers, and we have 3 strategies, 2 long-only strategies and a hedge fund with a value style process. I will turn it over to Scott, Simon, and then Kim to introduce themselves.
Good evening. My name is Scott Davies. I'm the CIO and founder of CDAM. We are a London-based investment manager that's been going since 2006. I've been in the business for 30 years now. I've kind of covered all aspects of the trading and investment world, so fixed income, equities, and some commodities in between. We run a hedge fund and a long-only product, so we have a protected equity product. And again, to the topic of this conversation, it's value-based as well. So that's me in a nutshell.
Good evening, everyone. I'm Simon Denison-Smith. I am the portfolio manager and founder of Metropolis Capital. I came into the industry in a slightly circuitous route. I started as a management consultant with Bain & Company, then set up a software business, which I ran until about 2006. I sold that business and then set up Metropolis Capital about a year later. And we run a long-only global equity strategy. It's a single strategy. We invest in around 20 global companies and do that on behalf of mainly institutional clients, but also some retail clients in the UK.
Simon, so I'll introduce myself. I'm Kim. I'm a portfolio manager at Marble Bar Asset Management. I came in via the industry as well through a management consultancy route. I studied in actuarial studies and history and philosophy of science in school, and that led me into a career with Willis Towers Watson. And then I joined Marble Bar in 2019 to actually run a portfolio within them with a value bent and a value strategy. We are long short, and we are multi-strategy hedge fund based in London. And within it, I run a European, Asian focused long short fund.
Thanks, everyone. To start off, given the topic of the panel, I think we'll just start off with maybe Scott and Simon, and just what is value investing? What does value investing mean to you and mean to your investment process and the way that you approach whether it be listed equities, fixed income, commodities, any sort of asset class?
Scott, do you want to start?
Sure. If you want to go, yeah, jump in.
Okay. So value investing is essentially, at its very basic level, it's the process of assessing the value of an asset. That asset could be anything. It could be an equity, obviously, and that's what we invest in, but it also could be a house. It could be a piece of clothing. It could be an art, piece of art. And having the skill to assess the value of that and then essentially investing in it at a significant discount with the hope that at some point you'll be able to, make money from selling that asset on at a price that's considerably higher than what you bought it for. I think it's quite a broad church. If you go to the London Value Investor Conference, which happens annually, it hasn't happened for a couple of years now because of the lockdown, you'll find a lot of different practitioners who apply that style of investing in a lot of different ways. And so it does mean different things to different people. But probably, to me, the thing that sort of differentiates value investing from a lot of different other types of investing, some growth investing, not all, but more sort of day trading, momentum investing, is that we tend to see price movements, particularly price movements down, as an opportunity rather than as a signal. By that I mean, we see it as an opportunity to buy more of something that's just got cheaper that we thought was worth more, rather than thinking that everybody else thinks it's worth less and therefore we should sell it.
I think, building off of Simon's point on it being broad, I think that's really important. There are different ways to look at value investing. I think the world today tries to squeeze it into a very narrow definition, which sort of leads people to look at growth and value kind of metrics going on in the markets, and that's not necessarily representative of what it is. As Simon mentioned, at the heart of it, it really is trying to value and trying to buy something at a fair or discounted value that you think can continually produce returns for a long period of time. And that's really the art and science of it. And so I think there's different ways, and people have different, approaches which suit their personalities, which is very important as well. But what you don't want to do is let your personality be defined by the way you invest. You have to have some flexibility. There's lots of ways to do it. You have to be able to adapt and develop with value investing, and always go back to that bottom line, that you're trying to put a valuation, and that valuation is important to you. Buying something at any valuation leads to all sorts of problems. But if you stick to the discipline of value investing and continue to look for the right valuation, or a valuation that you can prove out that's fair, I think it steers you in the right direction.
Great, thanks. Kim, from your perspective, what are some of the common misconceptions that people have around value investing?
I think what both Simon and Scott have alluded to, some of the things that people put into buckets. I think one of the very, very basic misconceptions is that value investing is all about buying the cheap stuff, low PB, low PE, and therefore, they must be good and they must be undervalued by the market. I think that is number one misconception, because anything with 5 times P can easily halve and become 2.5 times P, and it will still be cheap. It's about doing the background work to understanding, like what Simon and Scott have actually said. What do you believe is the fair value of the business? A business could be 5 times, and it could actually, the fair value could be 2.5 times, and buying at 5 times is not cheap. So basically, it's doing the background work, the fundamental work, and to understand what is about this company that the market might have missed, and price action is something that could follow through afterwards. And that's the number one misconception. Value investing is not about buying cheap stock. I think the second one is about the thing about value investing. Just because you're value investing doesn't mean that you cannot be a growth and quality investor. It's about finding companies that are good quality companies that you believe are still cheap enough that the market has not appreciated, and you buy it. And the same thing for growth company. It might be something that a lot of people say that a value investor is not a growth investor. It can be. There are hidden growth inside value companies that you don't know. So it's about the work that you do, and finding that little differences to basically have your own intrinsic value of the company. And that could be various numbers of metrics that people use in the industry. Could be free cash flow, could be PE, could be EV, EBITDA, lots of things that we actually study in school. So that's the number two misconception about that.
I think the only thing I would add that's important for the conversation and the people listening is that value investing isn't limited to the finance world. There's a lot of CEOs and the people that we invest in that are wonderful investors, and it continues to be a very, very broad spectrum across a number of different companies. I would think that maybe the finance industry is the smaller part of it. People who are allocating capital within their own businesses are probably wonderful value investors because they know what it takes to grow their business. They know what it takes to acquire a company to help grow their business. So I would say when you're thinking about investing, don't just think of it as something to do with the finance industry, a bank or a fund or anything else. There's companies that do incredible jobs, and you know, I think any investor or any would love to tag along with some of these CEOs, and some of them are public, and you can, and that's our job, and some of them aren't, and you just read about all the wonderful things they do. So it's very, very broad. It's not contained at all.
I think that's a really good point. So I think just to summarize what all three of you have kind of said, or the common theme between all three of your answers was mainly looking for assets that you think the market is undervaluing, essentially. Is there anything else in all three of your investment processes outside of that sort of main theme, or in addition to that main theme, that you consider important to your own sort of investing style, whether it be consistent with a kind of traditional value investing or outside of it?
Well, I think Kim touched on it a little bit, in the sense that, and I think Scott's quite similar to us in this respect, is that most investors that we know who've been sort of successful in the last 10, 15 years have quite a strong quality lens to what they do. And the reason for that is because it's actually quite difficult to find stocks that are trading on very low PEs. And so you have to look a bit deeper and really try and understand the sustainability of the business models that you're investing in. And I think from the perspective of the audience, that's what makes it really interesting, because actually anybody can get a spreadsheet up and look at, and generate lots of quant data and decide that something looks cheap just based on that quant data. But what makes, in my view, what makes value investing really intriguing is that really most of the effort goes in trying to understand the business model. And it really suits people who are interested in businesses and interested in understanding different business models and trying to figure out which business models are going to be durable, and also how those business models will grow over time, which comes to the point that Kim was making, that growth and value actually can be the same thing. And building models that actually fundamentally are underpinned by, deep assessment of those business models and industries. And that kind of analysis, I think, is a constant learning curve. It's fascinating, and is great fun. And it's what makes me and our team tick and get up and go into work every day, as Buffett says, skipping to work every day.
Mm-hmm.
I can, to Simon's point of view as well, in addition to that, actually, what I do a lot is understanding the competitive threats to the business and the business model itself, just to understand who are the new competitors. It might not be somebody who's listed. It might be something that is so left field and out of the blue that you've never heard of. And to understand, what do the customers want for this business? What are the suppliers in this business? Do they treat the suppliers correctly? Do they treat their stakeholders and employees fair enough that, even though it's a great business model, you still also want to be like, I want to go to work. I want the employees to feel like they're also going to work, so they're contributing to growing that company. So to me, the softer bits of it is like what Simon has said, anybody can build a spreadsheet. It's the softer bits of trying to understand the business model. What are the competitive threats or competitiveness about this business model that is great? Can people enable it to become from a good company to a great company? And what is the journey? The journey is never going to be, you go from good to great in one day. It takes 5 years to build it, 10 years to build it. Things like that people don't ask, and you do all the work. And every day I get excited trying to get up and say, who can I talk to? Which customer can I call? Which suppliers can I find out what's going on with this company? Things like that actually adds to understanding, how robust is this business?
I think for us, we would build off of what both Simon and Kim were saying. We try to look at it as two machines: the operating machine, that's how the business runs every day, and then the second part, once we can get our head around that, we we try to figure out the capital allocation machine and what are they doing with the money they earn. And we think that's the fascinating part of the business. And so we spend less time on, diving into the company if we can't get our head around that the company knows what it's doing and is operating effectively. We normally don't get much further, but we think the two machines, the business operations and the capital allocation, is what motivates us, and especially that second one, how they've earned some money. What are they going to do with the money, and how do they think of that? And that's sort of a really exciting journey in talking to CEOs about that. We find that very few people talk to a CEO about, hey, you just made record profits last year. What are you thinking of doing with it? And what are your plans? And do they understand the return? Do they understand what their other opportunities are out there? So for us, that's an important part of what we do.
That's a great point. Kim, how do you think about value investing on the short side, given the fund that you run is both long and short?
I think it's very simple, yet it's also quite a difficult thing to do at the same time. A lot of the companies and the good attributes I look for in companies that I want to hold forever, the short companies are the ones that when I dig further, they seem too good to be true. And sometimes it comes from both the operational side and as well as the financial side. So financial allocation, the balance sheet approach of it to say, hey, whatever they say, is it true? Does it actually flow through? Do they actually make money? Do they follow through whatever they said their governance are? So if the companies actually don't often do that, then it goes onto my shortlist. But to qualify further as a shortlist is actually to find companies that actually back culprits in the industry. So it might look like they're the best company out there, but operationally, as well as financially, they have issues, and the issues are almost the flip side of what I look for a good company. So, but shorting takes a lot of the other stuff as well. So it's not only just about finding that, it's also having a plan to say, look, this company could be a fraud and could be a fraud forever. What would it take for it to go down? So basically, on the short side, there will be further laid out catalysts. They are far shorter term than I would say in the long run. And this catalyst must be fulfilled in order for me to go and short a company. Saying that they're doing financial re-engineering is not good enough. It must be that they will run out of money, and therefore they run out of money, they get indebted. And if they're indebted, they need to come out and to the market to raise equity, or they collapse. So those are the issues that will have to come through. So the financial bits of it actually is probably more significantly important for the short side than, say, the operational side.
Mm-hmm. Very clear. A question, I guess, for all three of you, maybe a bit broader than sort of the specific value investing that we've spoken on so far, but what experiences have led you to kind of develop this style or approach to investing, and maybe what are the skills that you have found most helpful in your success?
Scott, do you want to go?
Sure. Well, I had a different start. So I came up through the fixed income markets at JP Morgan. So I was the good old-fashioned bond trader when I started in the business, and in the days where risk was on a sticky note, and you had to think about a number of different things, and so when I first heard of Warren Buffett or anything like that, it was sort of later in the 90s, and it sort of seemed interesting to me. And fixed income markets I love, and it's the foundation of what I do. But it was also the balance sheet side of the corporate bonds and even the sovereign bonds. It was kind of interesting. And so when I made the jump over, I had a very influential CEO that I worked for at an insurance company when I left JP Morgan, and he was a value investor in every sense of the word, and really got influenced there. So my career really saw what it was like to be a day trader doing 200 trades a day to being a long-term investor in sort of an overnight process. And it really took to me. And I think, Buffett's words of, you either it kind of comes to you or it doesn't. I put a half truth to that, but in my case, it really did. It made sense. Long-term investing was really the way to go, and understanding, especially from the fixed income side, of what duration was on an asset, that equities were actually the longest duration asset, but people treated them as a very short-term asset. And that struck me very, very early on, and said, well, if you just held these for 10 years, you probably have a much better chance. And it was odd to me just how often portfolios turned over and everything else, and that's sort of been a journey that I've always had a side interest on. So for me, it was that crossover. It was the application of seeing what it was like on the sell side, going to the buy side, seeing a lot of, in those days, would have been high frequency trading, to long-term investing, and really finding what was suitable to me personally.
So in my case, I mentioned that I started a software company. I was also on the board of a media business, which was run by and set up by my co-founder in the fund, Jonathan Mills. And we were running around the States in the early and mid-90s trying to sell guidebooks to tour operator companies. And we picked up a book written by Rob Hagstrom. It's a good book about Buffett. And we were intrigued to find someone who's investing in the public markets, but very much with a business owner's mindset. And that kind of resonated with us. And so about a few years later, Jonathan went to the shareholders meeting in Omaha and came back and sort of pitched the board that we should look to use some of our free cash flow to buy other businesses, but doing it very much on an investment basis. We weren't trying to find synergistic acquisitions. We're just trying to have the patience and discipline to buy other private businesses at prices that were below what we valued them for. And over the next 10 years, we did something like 30 acquisitions, and it was really very positive returns to our shareholders. But we always were sort of intrigued by the fact that Buffett had a foot in both camps, and we liked the idea of trying what we'd done to the public markets. And that's when we decided to do that in 2008, and have never looked back. And I think the attraction of doing it is that by comparison to buying whole private businesses, there's much less friction, and there's a much more interesting universe. When you buy a business, you have to, the interesting bit is analyzing it and agreeing. You agree a price. That's slightly less interesting because there's a bit of back and forth, and it takes a while. And then you go through due diligence, which is and a sales memorandum, and then a legal agreement, and then you get the business, and then you have to sort out issues within the business, and it's actually quite wearing. Fun for a while, but it has limitations, and actually all the fun bit is that initial assessment, and that's what we decided we'd get from moving into the public markets, and so that's where we ended up, and we're loving it. In terms of the skill sets, I think curiosity is really important. So I guess less skill sets and more character traits. Curiosity, I talked about passion for understanding businesses and being interested in businesses. This is for equity investing, clearly. A desire to keep learning and improving. I think, in that tortoise versus hare metaphor, Scott touched on this. Value investing is very much more in the tortoise camp. You're doing everything deliberately, patiently, and waiting for returns. You're not expecting everything to happen quickly. And so having that patience is really important. What I would say is that it doesn't need a mathematical degree. Jonathan is mainly focused on politics and philosophy at university. One of our analysts, we've got quite a small analyst team, studied classics. It's really not any sort of intelligent analytical degree is a good basis for becoming a successful analyst.
Okay, thanks, Simon. I think I can follow up from there. I started very, very quantity, basically. I did actuarial study, mathematics, operation science, and history and philosophy science. It was actually something that led me to my career in China, where actually what was really fascinating was learning about the human aspects of investing. and human aspects of running a business, the operation side, where I had to restructure the Chinese company, a state-owned enterprise company, to be privatized. That taught me that, hey, hang on, everything is not about numbers. A lot of things are actually the human elements in there. And after that, I actually changed my career into M&A, corporate M&A and corporate development, corporate finance, where I learned a lot about capital allocation, actually advising companies about how to do fundraising, do acquisitions, basically. So my skill set is actually much more combining the quantitative as well as the qualitative aspects of it into where I find the most interesting ideas. And I agree totally with Simon. It's about, I guess I'm lazy. I hate to say this, I'm lazy. I rather take the time and patience to find something that I actually understand the company rather than just seeing ticks and various things on the screen that tells you the price is up, and I have absolutely no idea why the share price is up or the share price is down every single day. I find that approach is too tiring. And it's not fascinating enough for me. I'm far more curious about asking, why is this company generating excess capital? Why is this company doing better than its competitors? Why is this company not doing as well? And asking why, and understanding, what are the differences that actually cause a company to be able to be better than its peers or worse than its peers in the case if it's a short. So it's actually a combination of understanding and using my skill set in both understanding the human elements of a business, as well as the quantitative side of it, which I can do through my spreadsheets, through my learning in university, that combines to give me my investment process. So it's basically a lot of what Simon says, but I tend to put it in a little bit more quantifiable metrics because I like maths. I still love maths, and I still like to put it in such a way that I actually can see it quantitatively. And that allows me, in a way, to give me a good investment checklist and follow my process through.
We've sort of touched on this maybe a bit in the previous questions, and each of you have hinted at various things, but maybe to ask the question in a more direct way, what advice or steps to take or sort of practical things would you tell somebody to do that's looking to form their own investment process? Simon, you mentioned curiosity, and you mentioned we've all kind of spoken about a true understanding of business models, but is there anything else that you would really advise someone who's looking to start figuring out what way to invest works best for them?
So, I mean, I think it is a good idea to try and identify. It's a bit lonely to try and do it on your own. So I think it's a good idea to try and identify other students who are interested in this area and form groups. A good technique is that you form a group, share club, and that you each go away, find a company that you think might be interesting in investment, and pitch it to each other. And you learn through the process of presenting that idea and then listening to what other people say and the questions they ask. And I think that sort of proactive step to really sort of build some sort of experienced understanding of what it's like to look at a company from an investment perspective and to try and persuade somebody else that you think it's a good investment is a really good first step in the process. And it also, what it does importantly is potentially gives you material that you can then talk about in an interview, which is quite important. I think that it's clearly a very competitive field. It attracts a lot of candidates who want to join investment management, and I think people who have spent a bit of time looking at companies and are able to talk intelligently about a company is always interesting to an interviewer. Scott, do you want to add anything to that?
Jim, if you wanted to jump in, I thought.
Well, are you jumping in or?
No, go ahead. I'll go after you.
I think I really I think what Simon has said is great as well. And what I will also say is also to help yourself form it, think about maybe 3 to 5 ideas or 3 to 5 checklists. What makes you think you like a company? It could be qualitative or quantitative. It doesn't actually have to be a metric, but write it down so that you can keep repeating the process of trying to see what actually is interesting about this company. So you actually have a process of looking, maybe these 5 things that are very key for me. And it's actually different for every different individual, because based on your background, based on what you've learned, what you've read, these 5 bullet points could be very different. And you can share with your friends within the share club as well. Because then you can think about what is a good process and how do you think about these are the 5 things that are key for me for this company.
I think my input would be to sort of put a layer on top of everything and try to be honest with yourself about what is really suitable to you. There's no point, if you're not a person that likes conflict, then going in for change management is probably not your best investment approach. I think it's really important to find something that you like. Secondly, as both Simon and Kim have said, this business is really about curiosity, and if you're not curious about maybe the boring side of something that most people would find boring, or just how the business works, or any part of it, it can be difficult. So being honest with yourself and saying, I really love looking into this stuff. I'm really curious about how this business or this industry works, and that's what kind of drives you every day. That's the sort of happiness factor that Simon talked about, or Kim saying she likes to quantify things like that. It's because of the curiosity, and I think that's really, really important. And people say it, but having lived it and also having to, build a team around it, it's what drives the team. We come in every day kind of asking a question about something that's sort of niggling at us and wanting to kind of explore it a little bit deeper. So for me, the top layer is, be honest with yourself, what really suits you as an investor, and try to stay within your own personality. And then the next thing is, are you curious enough for this business? Because it goes on and on and on. It's a thread that just keeps on getting pulled.
Yeah. Outside of starting to think about maybe things that you think are important in a company or in an investment process, and thinking about companies and being curious more generally, what advice would you have for someone that's looking to get into a portfolio management type role, such as the ones that you all have, or even an analyst, or maybe to ask the questions slightly differently? What sort of things are you looking for when you hire junior people, and what's the most important thing to you all?
I could step back in again. I mean, for me, we're a place where you could sit down and the next day get an idea in the portfolio. So we've never sort of blocked ourselves where all the decisions are made by me as the CIO. So I would say to anybody, make sure you choose the right place for you. Understand where you're going to have to fit in to get your idea in the portfolio, or to get to be a portfolio manager. Can you be a portfolio manager at a certain place? So that's really, really important. And know, is this going to be a learning institution, or is this going to be something by osmosis where you're going to have to do a lot of work yourself, or is there going to be some good mentors there and things? So it's very important to know what you'd like out of the place. So for us, we like to think that we can teach. And so, as Simon said, we really don't care about the background. We think that business isn't all that complicated, and having a quant background or a classics background, it really doesn't matter. It's, again, the personality, the curiosity for us, and we think we're a pretty flat structure and open to it. I definitely don't think I'm the smartest person in the room. I probably have the most gray hairs that I can lend to everybody, but some of the young people that join us definitely have some wonderful ideas that I want to be open and build upon. So I think it's important to know what you'd like and know where you'd like to be in your career, and then understand the firm that you're going to. Does that suit you? It's some places you can't be the CIO. Some places you have to work your way up through a chain of analyst steps to get to the next level. So that's what comes off for me.
Yeah, I mean, one thing that I would say is that a career in investment management does not have to end in portfolio management. I mean, we see a lot of people who are very happy in the analyst role and find it absolutely fascinating and endlessly fascinating, and it goes on forever. It's also a great role from the point of view of having flexibility in your life, because you're not having to manage the day-to-day portfolio. You can power down to a 3-day week and still add a lot of value as an analyst. So you typically in this industry, you start as an analyst, clearly, and then you have a point in your career where you will make a decision about whether you really want to become a portfolio manager and actually run. And then you have a decision about whether you want to do that within a large company or whether you want to do it on your own company. And that sort of progression happens over time. But I don't think you have to come into the industry thinking that you're going to end up as a portfolio manager. And being an analyst is not only potentially very remunerative, but it's also something that many people really enjoy in this industry, and they're highly respected. What we term as Uber analysts are highly respected part and very important parts of the value chain in investment research.
I agree actually with what Simon says. It's sometimes it's actually, you don't have to be bothered looking at your portfolio management and your risk assessment. You can just concentrate, if you know who you are, that you actually like looking at companies and only company fundamentals, and not have to figure out how does it fit together with the overall portfolio and the sizing of it. A lot of my friends are great analysts and they love doing company digging, company work, and not think about portfolio and risk management. And I think that's the biggest difference between, I think, being an analyst and a portfolio manager, that you have to divert some of your time that you love looking at a company into portfolio management and risk management a little bit. Whereas as a pure analyst, you can just concentrate on just looking at the great ideas in the companies that you would like to buy or have a different opinion about. I think what I would like what I would like to tell myself if I was a bit younger is actually a little bit more passion, a little bit more humility as well. When I'm just starting out a career, sometimes when we're a little bit younger and stuff, we tend to be a little bit cocky, and a little bit of humility to actually say that, hey, I'm wrong, and this is why I'm wrong, and I'm happy to discuss why am I wrong and why in the future, I will look at things differently. You will never be able to always, you learn from your mistakes. And I think I would tell myself when I'm much younger, straight out of business school, to be a little bit, have a little bit more humility, and yet show the passion in such a way that you don't appear to be that cocky.
Yeah, Kim touches on a really important point, because there's a weird balance of personalities that's required in successful investment, which is having conviction and really believing in your idea, and then having the humility to take in new information about that idea and accept that you were actually wrong and learn from it. Those mistakes should be gifts. You should learn from them and move on. But often investors fail because they are too high on their conviction, and they filter out. It's a classic behavioral weakness. You filter out the information that you receive that is in any way negative to your thesis, and only look at the information you receive which is positive to it, and so it's constantly reaffirming, and you stick with it, and actually the investment doesn't work out because you weren't properly looking with a completely objective mindset, and that sort of combination of personalities is a really interesting one.
What Simon said about the differences between the role is probably important to emphasize as well, that the portfolio manager role is really a step away from getting to the company analytics and all that sort of stuff. I can say that you miss it at times, because you are looking at the risk in the portfolio, the composition of the portfolio, the cash levels, and everything else that you need to do as the portfolio manager, and you don't get to focus 100% of your time on company analytics or searching for that next best idea. And people should understand, as Simon rightfully put out, pointed out, that an analyst role in the Uber analyst, as Simon said, is it's as important, if not more important, than the portfolio manager. And putting together sort of the 20 ideas that we have, or Simon has, or Kim in the long short side is that role. But then when the people who are telling you this is a great company and is completely different. So very different roles, and I wouldn't say they're on different levels at all.
Yeah, the other thing I would add, just sort of slightly aside to this, is in terms of sort of preparing yourself for this industry, particularly if you want to be in equity investing, reading business biographies is a great way to build your knowledge. And if there's one I can recommend, it's Shoe Dog, which is the business biography written by Phil Knight, who set up Nike. Is a great first step in that journey of reading business biographies. It's a great read. It really gives you a feel for the trials and tribulations of starting a business in a space that we all understand and know. And that's a great, a really good way of also, again, and I go back to helping you to think through what you're going to say in an interview and being able to talk about books that you've read about businesses, as much as, there are great investment books as well, but about businesses is really helpful in those kind of interviews.
Yeah, I mean, I've just, that for us, that's essential. I mean, even at work today, we have a book club. You're required to have at least one book a month. That would be very low for everybody in the firm. It doesn't have to be a business book, but you have to be presenting something to the group once a month. And we go around the room and everybody kind of gives their quick 5 minutes on it, but it's required. I mean, I think that learning off the experience of others is how you can boost your own knowledge as fast as possible, and it really makes you prepared for interviews and everything else. And even for our roles today, when we have to talk to allocators, potential investors, all that sort of stuff, to stay up with what's going on out there, even as the world changes so quickly, the best source is a biography of somebody who's just done something, or the transition they've made into a market. So reading is everything, I think, in every business anyway. So staying up with it, kind of that lifetime learning, as many people have called it, is essential.
To that end, Scott and Kim, do you have books that you recommend? Maybe one or two books that you think were critical to your understanding or helped you think in a different way?
Okay, I'll start. I think one of the books that I actually have always reread and stuff is Jim Collins, From Good to Great. It's about companies and how companies and management have made changes. And there are a few simple case studies in there so that it can get you started thinking, and about how companies evolve over the years, and and how management have made decisions that way. And another book that is probably much more financial related, if you're still in university, is Financial Shenanigans by Howard Schmidt. And about, trying to actually figure out what it is not what it seems. And it's actually quite a hard book to read, but, when you're still at university, it's great because, especially if you didn't study accounting or economics or any other STEM subjects, he made it look in such a way that is simple. There's are some simple things that even if you've studied classics, or if you've studied history and geography, you will be able to read it and actually get a sense of it. So this is actually the book that I would recommend, this too.
For me, I mean, there's a long list. Many of the titles are kind of well known by people. We sort of share a book list, but I think a book that really caught my attention earlier on was Munger's book, Seeking Wisdom. It was sort of this quilt of different sort of thoughts and everything else, and it just got me curious about going everywhere and thinking about different areas, and that kind of introduced sort of his lattice work thinking, and that sort of opened a lot of things up for me, where you should be thinking about different disciplines and everything else. So that was great. And then one that I would pass on, it's a really popular book, and he's kind of a pop finance writer, but I think it's good. It's the Psychology of Money by Morgan Housel, and it's a very fast read, but I think if you're new to the business or new to just managing money or even for personal finances, he makes some really good, and I've passed it on to a number of students who aren't in finance, and they've loved it. You know, when he writes a chapter on how Buffett has made 85% of his wealth after the age of 65, it kind of makes people sit and ponder, and then he walks kind of through how it's done and that was his introduction to compounding and everything else. And so, you know, when people kind of scratch their head about that gosh, this guy became uber wealthy, but it didn't happen until he's 65, and he stayed in it because of how long he stayed in the game. So I sort of like that one if you wanted just to sort of see what it's about. He writes well. It's an easy read. It's doesn't get too deep or anything. So that's the two I would put out there.
Yeah, and I'm sure this one's on both of your bookshelves as well. Is Outsiders by Malcolm Gladwell, which is a terrific, and again is a terrific read. And it also, in a sense, it's condenses lots of biographies into one. So it gives you each chapter covers a single company of outstanding. It goes to Scott's comment earlier that a lot of value investors can actually be found within the CEOs, and this talks about exactly those CEOs who are fantastic capital allocators, and is a really good grounding both from a business perspective and also from an investment perspective.
Great. Just to kind of wrap up the questions that I have, and conscious that the audience may have questions, but what are just one or two things that maybe you think are the most important to your style of investing as a sort of conclusion?
Well, for us, it's as I mentioned at the beginning, we are all about capital allocation. We really want to know how the CEO thinks of that next pound, dollar, euro that he's made and what he's doing with it. That drives our curiosity. We love looking into that, and we spend almost all of our time on that sort of stuff. So our process has very much evolved from trying to understand the way a business works to not spending as much time with that, but just trying to understand how the CEO then goes and spends the money. So for us, that's the main thing, and we love it.
I think for us, probably two things. One is, which I touched on earlier, the analysis of the business model and really trying to find business models which are incredibly robust and sustainable. And that does lend itself to being sensitive to, essentially the second bit of that is really worrying about disruption, and thinking about whether those business models are going to be around in the next 10, 15, 20 years. And so you inevitably start thinking about, when you think in those sort of long durations, you think about what are the potential threats. Some of those threats could be climate related, or could be the way in which they're engaging with their supply chain. Are they acting in the right way? And so I think those are the sort of two things that we spend most of our time on, which is thinking about the sustainability of the business model, and then in particular worrying about what are the things that could disrupt that, what are the risks around the corner.
I guess for me, it's much more thinking a little bit into finding the company actually, and finding the competitive threats in a way. So as to actually understand, is this company basically able to grow the way that I think it's going to be able to grow into the future? Or operationally, if it needs to cut costs and stuff, is it able to do it without actually harming its own products and customers? So I think competitive threats is possibly one of the main thing I will focus very, very much on. And the competitive threats could come from the likes of the customer, new competitors, suppliers, everything into that. And I would say the second thing I actually focus on is actually cash flow generation. In this actually current environment, especially last year in 2020, if a company actually runs out of cash, they run into trouble. And then they will have to do things that they actually do not want to, basically sack their employees and actually rebuild the whole entire operations again. However, if the company itself actually have cash as a background, and they're able to sustain that, it's actually very key. That's the best time for the company to be able to take the offense when everybody is on the defensive. And the great companies that actually rebounded back from that operation are the other ones who actually have that. So to me, the cash flow discipline is very important.
Very clear. At this point, we will open it up to questions. If anybody in the audience has a question, I think you can raise your hand or ask us directly, or there's a little Q&A button at the top or bottom of your screen, and we can see them that way. If anybody has anything that they'd like to ask any of us. I don't see anything coming through. We'll give it a few more minutes, but I guess in the meantime, maybe one more question from me. If you could each walk us through maybe one of your favorite value ideas, or whether it be a position that you have in the fund now or in the past, or just to maybe give us all an example of how you've thought about something and then how it's actually come to fruition as an investable idea.
Okay, so we think. I think when in a sense the sort of journey we had with Samsung was quite interesting. So you know, Samsung will be familiar to everybody because it's, you know, a strong electronics brand, but and at the time that we around the time that we were first investing, there was that whole thing of the Samsung phones bursting into flames, and that was hitting the share price. And that's a really good example of, you know, if you know the business really well, you can take advantage of the share price fall that occurs, because in reality, the phone business of Samsung was quite a sideshow to what they really do, which is, you know, they're the global market leader in making memory chips, and so that was the business that we focused on, and that was the business that we spent the most time really thinking about when we first invested in them. The interesting thing about that business, or that industry, and this sort of goes to some of the things that Kim was talking about, is that traditionally the semiconductor industry has been a horrible place to invest because it is massively cyclical. And essentially what happens is that all the suppliers ramp up production. You know, they start getting good demand, prices go up, they ramp up to production, they oversupply, the prices drop, everybody loses money, and it goes through these horrible ups and downs, which make it very difficult to invest. But what we recognized in 2013, I think it was 14, when we first invested, no, 2015, was that the business, the industry had consolidated, and actually that there was much more rational pricing coming into play, and that really played out well. So over the course of the sort of 5 or 6 years that we owned the stock, it went through several of those ups and downs, but each time it earned positive cash flow, very significant positive cash flow. And we ended up selling it a couple of years ago, too early, as it turns out, but we still made very good money on it at where it was valued. The cash it had on its balance sheet was more than the market cap that we had originally paid for it, and it had been a terrific investment for us. Now, the interesting thing about why we got out of it was, and it hasn't played out yet, but we still think it really has the potential to, is that we were very worried about excess competition from China, who've invested literally hundreds of billions of dollars into building their own capacity, and we believe that is a very difficult competitor to play against. Not necessarily as rational in terms of, you know, capital allocation as their current competitor set, and therefore we felt that we could no longer model out their future cash flows as predictably as we had in the past, and that was why we ended up selling.
I think one we could share would sort of illustrate something that we've talked about, being patient and being the long-term investor, and having a very long duration. We've invested in a company called Boyd Group for a very long time. It's what we call our tech buster. It's a company that has beaten any of the big tech companies hands down for last 10, last 15, pick a number, 40+% annualized return. And they buy auto body repair shops across Canada and the US. So it's not a glamorous business, but it's beaten tech hands down. Again, it just shows what a good capital allocator in charge of a business can do. And again, if you stay with an investor who's doing a good job and you stay with them for a long time, you can get incredible returns. And so for us, all we had to do was really just hook our wagon to them and watch him do what he did year after year, and that was pretty easy. And there was really lots of people talked about disruption and lots of people talked about everything, but he was a very disciplined guy that just kept doing and continues to do the same thing. There's a massive market for what he does, and so it was fairly simple. All we had to do was become convinced that he understood what he was doing a long time ago, and that there was enough of a business for him to do it, and both have turned out to be true. So it's sort of our tech buster, and we throw it out there for everybody who says there was only returns in tech. We say there's lots of returns outside of it, and here's a business where they just paint cars for a living, and they just go and buy mom and pop shops that paint cars. So yeah, that's kind of one that makes you smile.
For me, basically, about 6 years ago, I did a thematic piece into understanding what are the drivers into healthcare and healthcare into Asia. And biosimilar was something that was actually coming in there. So some of the companies that actually bought into that time were the companies that were like the shovels. They were the ones who actually were making the equipment that will actually enable big pharmaceutical companies to experiment and to actually make the drugs, and also actually come up with experimental drugs. So it's not exactly that I'm actually going gangbusters and to try and find the next gangbuster drug out there, but it's actually selling the little widgets and the little basically the tubes, the pipings that actually going to enable the companies to actually make more biosimilar and biologics. Because I saw that we're moving away and going into much more molecular healthcare, molecular biology. So that was something that actually led me to a few companies that currently right now were main beneficiary last year during the COVID crisis, but actually they were already in the radar for doing very, very interesting work 5 to 6 years ago. So this was also being patient, because actually really nothing worked. Not a lot of those companies actually needed time to mature. And my time plan for them to mature wasn't into 2020. COVID was I would say a happy accident. It was these companies are actually the forefront of where I think healthcare is going to grow. And it's a bit of a thematic work to think about where it's going to go in the next 5 to 10 years. And I bought the shovels. This is a little bit about Warren Buffett and what he says about not exactly buying the latest trend thing, but actually buying the shovels and the picks that is needed to actually enable the industry to successfully transition.
Great. Well, thank you all. It doesn't look like there are any questions coming through, so we're about 1 minute short of the hour. And thank you all for listening. And thank you to my fellow panelists. We hope you enjoyed the session. And I speak for myself, and I'm sure on behalf of the other panelists, but please feel free to reach out to any of us if you do have any questions or would like to get in touch. We're always happy to chat.
Erin, can I just wrap up with one thing I think we haven't really touched on?
Of course.
Which is that, I would really hope that all of you who are on this, who have listened to this panel, will see investment management as a really viable career for women. We've had something like 150 people apply to us over the 10 years we've been running the business for analyst roles. We just walk-ins because we don't do any sort of active recruitment. And literally, I would say about certainly less than 10, possibly about 5 have been women. I think it is less than 5. It's an industry which is crying out for a greater level of diversity, and actually will, it's an really important part of what we do, is to ensure that we have diversity of thought within our teams, and that requires, different ethnic mixes and different genders. And I would really encourage you all to really consider it. And if you have preconceptions that the finance industry is kind of a difficult place for women to work in, I think I would really ask you to try and explore that in a bit more depth, because I think that is changing very dramatically. And certainly in investment management, and long only investment management, and the type of investment management all three of us practice, I think it's an ideal environment for women to work in.
That's a great way to close. I think that's very, very well said.
Yes, that's
I
excellent.
agree.
I
Yeah.
totally
Thank you all. Hope you have a nice evening. Thank you.